Welcome. Today, we're going to untangle the incredibly complex world of US and Canadian cross-border tax. This is one of those areas where something as simple as your citizenship or even just how many days you spend south of the border can have absolutely massive financial consequences. Getting these rules right isn't just important, it's everything.
Just a quick note before we jump in, this explainer was prepared by Samir Al-Rashani with some AI support. Okay, let's get started.
All right, let's dive right in with what is, without a doubt, the most fundamental question of all. Are you a U.S. person for tax purposes? Now, you might think you know the answer to that, but it can be surprisingly tricky. We have to start here because in the eyes of the IRS, your status dictates every single obligation that follows. So here's our roadmap for today. We're going to walk through 5 key areas. First, we'll figure out how to define your tax status. Then, we'll look at the core filing requirements that come along with it. After that, we'll get into managing common assets like real estate. We'll also uncover the often overlooked U.S. estate tax trap, and we'll wrap things up with some critical planning considerations. Okay, first up, defining your U.S. tax status. And the subtitle here really says it all. Identity is everything. This one classification truly underpins how the entire U.S. tax code applies to your financial life. So, what does it take to be considered a U.S. person? Well, there are a few ways. Some are pretty obvious, right? Like being born in the U.S. or holding a green card. But it can also happen if one of your parents is a U.S. citizen, provided they meet certain residency rules. And then there's the one that catches a lot of people, a purely mathematical formula called the substantial presence test. Let's zoom in on that last one, because it's a huge deal for so many Canadians, especially snowbirds or really anyone who travels to the States frequently for business or pleasure. The key thing to understand here is that this has nothing to do with your citizenship or your intentions. It is a straight-up calculation based on one thing and one thing only: the number of days you are physically in the country. So, how does the math actually work? It's kind of interesting. It's not just about this year. It's actually a 3-year look-back formula. First, you take all the days you were in the U.S. in the current year. To that, you add 1/3 of the days from last year. And finally, you add 1/6 of the days from the year before that. And here's the magic number, 183. If the total from that 3-year calculation adds up to 183 days or more, well, you've met the test. For that tax year, the IRS considers you a U.S. person. And just like that, you've got all the filing obligations that come with it, no matter what your passport says. Okay, so let's say that happens. You've done the math and you meet the test. What happens next? That brings us right to our second section, your core filing requirements. Because as soon as that status is established, a whole new world of rules and regulations kicks in. Think of this as a major fork in the road. Your tax life goes down one of 2 completely different paths. If you're a U.S. person, you file a Form 1040, and, this is the big one, you're taxed on your worldwide income. That means everything you earn anywhere on the planet. A non-resident alien, on the other hand, files a 1040-NR and is only taxed on their U.S. source income. And as you can see, their key compliance issues are just worlds apart. Now, for U.S. persons living outside the States, there are 2 reporting acronyms you absolutely have to know: FATCA and FBR. FATCA requires you to report your foreign financial assets if they're above a certain value. But FBR is even broader. You have to file an FBR if the combined total of all your non-U.S. financial accounts hits just $10,000 at any point during the year. And here's the kicker. The scope is massive. This isn't just about your personal checking account. Let's say you volunteer as the treasurer for your kids' soccer team in Canada, and you have signing authority on their bank account. Guess what? That account has to be reported on your personal FBR. This brings us to a really vital point. You have to understand that these rules are fundamentally about disclosure. It's not necessarily about collecting tax from you. The IRS simply wants to know what you have and where you have it. Because of that, the penalties for simply failing to file these informational forms are frankly brutal. They can be incredibly severe, often far more than any tax you might have owed. The system punishes secrecy more than anything else. Okay, let's get practical and move into our third section. We're going to apply some of these principles to 2 of the most common assets people have across the border: real estate and retirement funds. So let's say you're a Canadian and you sell your condo in Florida. A U.S. law called FIRPTA kicks in, and this is where it gets a little weird.
The responsibility for the tax isn't on you, the seller, it's on the buyer. The person buying your property is legally required to hold back a big chunk of the sale price and send it straight to the IRS, just to make sure any potential capital gains tax gets paid.
And we are not talking about a small amount of money here. For properties sold for over $1 million, it's a flat 15% of the gross sales price, not the profit, the entire sales price. Now, that rate can sometimes be reduced to 10% or even 0 on lower-priced properties, but there's a catch. The buyer has to formally declare they're going to use the property as their personal residence. If they don't, that 15% rate applies.
All right, let's talk about retirement plans, like a U.S. 401k. This is a classic cross-border puzzle. Let's say you move back to Canada and want to bring your retirement money with you. From the U.S. perspective, taking money out of a 401k is a taxable withdrawal, period. So they'll automatically withhold 30% for taxes right off the top. But from the Canadian perspective, you're allowed to roll that money into an RRSP tax-free. See the problem? You only have 70% of your money left to contribute. To make your RRSP whole, you have to come up with that missing 30% from somewhere else, and then go through the complicated process of trying to claim a foreign tax credit from Canada for the taxes you paid to the US. It's tricky.
This brings us to Section 4, and this is a topic that catches so many people completely by surprise: the U.S. estate tax. It's critical to understand that the basic philosophies of how Canada and the U.S. tax you at death are night and day different. This slide shows the core conceptual trap perfectly. In Canada, when you pass away, it's what we call a deemed disposition. It's as if you sold all your assets right before death, and your estate pays tax on the capital gains, that is, the growth. The U.S. system is totally different. They have an estate tax, which is a tax on the total value of your assets, not just the profit or the growth. It's a fundamental difference.
Now, you might be looking at this number and breathing a sigh of relief. And it's true. Currently, every U.S. person has a lifetime estate and gift tax exemption of over $11 million. That's a huge number, and it protects the vast majority of estates from ever paying a dime of tax. But, and this is a big but, that number is not permanent.
And here is the catch. This is the ticking time bomb of U.S. estate planning. This high exemption amount is not permanent law. It was created by temporary legislation that has a built-in expiry date. In 2026, unless new laws are passed, this exemption is scheduled to be cut roughly in half, automatically. That means a huge number of estates that are completely safe today will suddenly be exposed to a massive tax bill in the very near future.
And this tax trap isn't just for U.S. citizens. For Canadians, it applies to any U.S. situs assets you own. What does that mean? Well, some are obvious, like U.S. real estate. Others include tangible things you own that are physically in the U.S. Think of art or furniture in a vacation home. But here's the one that shocks almost everyone. It includes stocks of U.S. corporations. Think Apple, Microsoft, Google. Even if you hold those shares inside your Canadian brokerage account, for U.S. estate tax purposes, they are considered U.S. assets. All right, let's bring this all home with our final section. I want to highlight some very common Canadian accounts that can create completely unexpected problems for U.S. persons, and talk about the general path forward. You see, many of the absolute cornerstones of Canadian financial planning become compliance nightmares for U.S. tax filers. Take the tax-free savings account, the TFSA. The IRS doesn't see it as tax-free. They view it as a foreign trust, which triggers incredibly complex and expensive annual filing requirements. The same thing goes for an RSP, the education savings plan. And if that weren't enough, most standard Canadian mutual funds are classified as something called PFICs, passive foreign investment companies, which are subject to some of the most difficult and punishing tax rules in the entire U.S. tax code. So as you can see, from the very first step of just figuring out your tax identity, to managing your assets, to planning your legacy, this whole landscape is a complex maze of conflicting rules, different definitions, and hidden traps. Trying to navigate this world without a clear map isn't just risky, it's a profound financial hazard. That's why proactive planning with a qualified cross-border specialist isn't just a good idea. It is absolutely essential.